Keltner channels consist of three main components that work together to help traders analyze price movements and volatility. To understand these components, let's look at a sample price chart. The first component is the middle line, which is typically a 20-period exponential moving average, or EMA, of the price. The second component is the upper band. This is calculated by adding a multiple of the average true range, or ATR, to the EMA. The third component is the lower band, which is calculated by subtracting the same multiple of the ATR from the EMA. The ATR multiplier determines how wide the channel will be. The default value is 2, but this can be adjusted based on your trading preferences. Here's how different ATR multiplier settings affect the width of the channels. A higher multiplier creates wider channels, which may reduce false signals but could delay trade entries. Notice how the channel width expands during periods of high volatility and contracts when price movement becomes more stable. This adaptive nature is one of the key advantages of Keltner channels. Now let's explore the calculation method for Keltner channels. Keltner channels consist of three main components, a middle line and two outer channels. The middle line is simply a 20-period exponential moving average of the price. The upper channel is calculated by adding a multiple of the average true range to the middle line. Similarly, the lower channel is calculated by subtracting the same ATR multiple from the middle line. The average true range, or ATR, is a key component of Keltner channels as it measures market volatility. ATR is calculated by averaging the true range values over a specified number of periods, typically 14. The true range accounts for gaps between trading sessions by taking the maximum of three measurements: the current high minus low, the absolute difference between the current high and previous close, or the absolute difference between the current low and previous close. Let's visualize how Keltner channels adapt to changing market conditions. First, we plot the price action of the security. The middle line is the 20-period exponential moving average of price. The upper and lower channels are constructed by adding and subtracting a multiple of the ATR from the middle line. Notice how during periods of high volatility, the channels widen as the ATR increases. Conversely, during periods of lower volatility, the channels narrow as the ATR decreases. Let's work through a simple numerical example to understand the calculation better. Consider a stock with a 20-period exponential moving average of $50. Let's say the 14-period average true range is $2.50. Using a standard multiplier of 2 for the channels, the middle line is simply the EMA at $50. The upper channel is calculated by adding 2 times the ATR to the middle line, resulting in $55. The lower channel is calculated by subtracting 2 times the ATR from the middle line, resulting in $45. As volatility changes over time, the ATR value will update accordingly, causing the channels to adapt and provide relevant support and resistance levels. Keltner channels and Bollinger Bands are both popular technical indicators that use a central moving average with upper and lower bands. However, they differ significantly in their calculation method and behavior. The fundamental difference lies in how the bands are calculated. Bollinger Bands use standard deviation, which measures price volatility directly. Keltner channels, on the other hand, use average true range, or ATR, which measures trading ranges. Let's see how these indicators respond to a significant price spike. Notice how Bollinger Bands expand rapidly when volatility increases, while Keltner channels remain more stable. The calculation method is key to understanding why these indicators behave differently. Bollinger Bands use standard deviation, which gives more weight to outlier movements. Keltner channels use ATR, which provides a more consistent measure of volatility. Because of these calculation differences, Bollinger Bands are more reactive to sudden price spikes, which can sometimes generate false signals. Keltner channels tend to be smoother, potentially reducing false breakouts in certain market conditions. Each indicator has ideal market conditions where it performs best. Bollinger Bands excel in ranging markets, and when assessing volatility is crucial. Keltner channels tend to perform better in trending markets and when you want to filter out market noise. Keltner channels are a powerful tool for identifying trends in the market. When a market is in an uptrend, the price frequently touches or moves along the upper band of the Keltner channel. Notice how the middle line, which is the EMA, slopes upward, confirming the uptrend direction. Conversely, in a downtrend, the price tends to move along the lower band of the channel. Here, the middle line slopes downward, confirming the downtrend. During strong trends, Keltner channels typically expand as market volatility increases. Conversely, during consolidation periods, the channels contract as volatility decreases. Let's summarize how Keltner channels help identify market trends. By recognizing these pattern behaviors in Keltner channels, traders can more effectively identify and trade with the prevailing market trend. Breakout trading is a popular strategy used with Keltner channels. Keltner channels consist of an upper, middle, and lower band that create a channel around price. Traders watch for when price moves outside these channels, as this can signal a potential trading opportunity. A bullish breakout occurs when price breaks above the upper channel. This signals strong upward momentum and can be a potential buying opportunity. Conversely, a bearish breakout occurs when price breaks below the lower channel. This can indicate strong downward momentum and a potential selling opportunity. Breakouts are most reliable when they occur after a period of channel contraction. When Keltner channels narrow, it indicates lower volatility. A subsequent breakout from this contracted state suggests a new trend may be forming. To summarize, Keltner channel breakouts can provide powerful trading signals, especially when they occur after periods of channel contraction. Keltner channels provide valuable information, but combining them with other indicators can significantly improve your trading decisions. Several indicators work well with Keltner channels. These include RSI, MACD, volume indicators, stochastic oscillator, and various moving averages. When combining RSI with Keltner channels, look for RSI to confirm channel breakouts or mean reversions. For example, a bullish signal occurs when price breaks above the upper Keltner channel, while RSI simultaneously moves above 70, confirming the strength of the trend. The MACD indicator works particularly well with Keltner channels because it captures both trend direction and momentum. A powerful signal occurs when price approaches the upper Keltner channel, while the MACD line crosses above its signal line. This combination suggests strong bullish momentum. Volume confirmation is critical when trading with Keltner channels. Higher than average volume validates breakouts, while low volume during price movements into the channel suggests weaker signals. Here, we see a bearish signal where price breaks below the lower Keltner channel with high volume confirmation. This combination suggests strong selling pressure and increases the reliability of the breakdown signal. For the most reliable trading signals, combine multiple indicators with Keltner channels in a systematic approach. Remember, each additional confirming indicator increases the reliability of your signals. The most powerful trading opportunities occur when multiple technical factors align simultaneously.